Picture this. It's 1997.
Okay.
And a highly respected institutional investor is looking at the Indian market. And a friend of his casually mentions a tech training company in Chennai called SSI.
Right.
And the friend says the demand for their coding classes is so intense, like the students' bicycles are literally toppling over in the stands outside the building. There's just that many people.
Just from the bicycles.
Right. Just based on that single anecdote, just the image of too many bicycles, the investor buys the stock. I mean, he doesn't open the annual report.
Oh.
He doesn't check the cash flow, none of that. He just buys it. And by the year 2000, that position has multiplied 500 times.
Which is just wild.
Right. He makes an absolute fortune, and it sounds like the ultimate Wall Street triumph, you know?
Yeah.
But the investor himself considers it one of the most terrifying, structurally flawed decisions of his entire career.
Yeah, and it is. I mean, it's the ultimate diagnostic nightmare. Because we love the illusion that outsized success is the result of these flawless, replicable models, right?
Yeah, exactly. The perfect formula.
But when you actually look at the reality of capital allocation, the foundation is so often built entirely on missteps, on sheer luck, and, profound diagnostic muddy waters.
For sure.
The difference between a retail investor and a titan isn't the absence of mistakes. It's the architecture they build to survive them.
Okay, let's unpack this, because today's deep dive is into Confessions of Stock Market Wizards by Safir Anand. But we are completely abandoning the usual playbook here.
We really are.
We aren't looking at how these legendary Indian investors specifically. We're looking at Samir Arora and Sanjay Bhattacharya. We aren't looking at how they found their massive wins in a vacuum. Our mission today is to explore the secret, rarely taught science of getting it wrong.
Yes, the science of mistake.
Exactly. We are dissecting how they weaponize their own psychological failures, their hubris, their miscalculations, how they used all of that to build enduring success.
And it applies to everyone, really.
Right, because whether you are managing a sovereign wealth fund or you're just, auditing your own career trajectory, learning how to engineer a survivable failure is like the highest leverage skill you can acquire.
It absolutely is.
Yeah.
And acquiring that skill requires bypassing a massive cognitive roadblock, which is the ego of the sunk cost.
Oh, that's a big one.
Yeah. And to examine how that works mechanically, we really need to look at Samir Arora, because he treats his entire trajectory, like starting from his very early education, as an exercise in ruthless course correction.
Right, because he gets into IIT Delhi for mechanical engineering, and passing that joint entrance examination is, it's a brutal, hyper-competitive filter.
Oh, incredibly tough.
So he goes, simply because the societal rule, the heuristic, is that you just do not turn down an IIT admission. Like, no one does that.
You'd be crazy to.
Yeah. And he even finishes third in his class. So by every external metric of the system, he is absolutely thriving. But internally, he recognizes this severe structural misalignment. He knows he wants to be in finance. But instead of doubling down on the engineering path he just spent years conquering, he abruptly pivots. He heads to IIM Calcutta, tops his class there, and then moves on to Wharton.
And the mechanism of that pivot is what's so crucial here. Because most professionals view a multi-year commitment to a rigorous degree like that as an anchor.
Yeah, like a chain around their neck.
Exactly. They will twist their career into knots trying to justify that initial investment of time and energy. But Arora, he treats misalignment simply as incoming data.
Wow. Just data.
Yeah, the ego insists on defending the initial hypothesis, right? But Arora realized incredibly early that if you let your ego evaluate your positions, you will ride a failing thesis straight into the ground.
You'll just crash.
Right. He took that realization and built his entire market philosophy around it.
Which he calls elimination investing,
Yes.
right?
Yeah.
But cognitively, rejecting an asset requires a totally different framework than selecting one. It's like your car's GPS, right?
Okay, I like that.
Like, when you make a wrong turn, the GPS doesn't let its ego drive you off a cliff. It doesn't say, well, I committed to this route, let's just keep going into the lake.
Right. It just says recalculating.
Exactly. It just recalculates. Why do we struggle to do that in our own lives? How does an investor actually bypass the ego of a bad public bet without getting paralyzed by the sheer volume of the market? Because it feels like triage. You aren't looking for the healthiest patient. You're just isolating the ones that are actively crashing.
You do it by focusing on the asymmetry of conviction.
Okay, what does that mean?
So Arora operates on the premise that your conviction in rejection is mathematically and psychologically higher than your conviction in acceptance.
Interesting.
Think about how we process complex data, right? Identifying a structurally sound, highly undervalued company with a perfect moat that requires dozens of variables to align perfectly.
It's a lot of work.
It's cognitively exhausting.
Oh.
But identifying a toxic asset,
Yeah.
that only requires one fatal flaw.
Oh,
If a company has, say, a history of atrocious corporate governance or a deeply over-leveraged balance sheet, you don't need to model their 10-year discounted cash flow.
you just drop them.
You eliminate them instantly.
So it's essentially an aggressive pruning process. You're drastically shrinking the investable universe before your inherent biases even have a chance to attach to a narrative.
Oh, precisely.
And he is incredibly candid about the fact that even with this rigorous filtering, errors are just part of the operating cost. Like, he compares taking a loss to a Sunday breakfast of a Chowder.
Right, his favorite comfort food.
Yeah, it's just this heavy expected routine. It's going to happen.
Because survival in the markets isn't about throwing the perfect punch every time. It's about ensuring you never leave yourself exposed to a systemic knockout blow.
You have to stay in the ring.
Exactly. Elimination investing removes the existential threats from the board. But, once you have cleared away the obvious landmines, the terrible management, the absurd valuations, you still have to allocate capital.
Right. You still have to buy something.
You still have to cross that threshold from rejection to acceptance. And this is where the contrast between our two wizards becomes a complete masterclass in market mechanics.
Oh, it is a wild divergence. Because on one hand, you have Arora, who is famously agile and leans heavily into broad intuition. Like back in the mid-90s, he makes a massive concentrated bet on HDFC Bank, and it pays off with a 500x return.
Massive.
Yeah. And he didn't stop there. He rode the same conceptual wave later with Zomato and Varun Beverages. But his intuition wasn't like a mystical feeling. He was identifying a macro structural transfer of power.
Yeah, he was recognizing pattern replication.
Okay.
Arora observed the mechanics of private enterprise overtaking public sectors in places like the US and China. Superior technology stacks, aggressive service orientation, and zero political bloat.
Right. They just move faster.
Much faster. So he looked at the Indian banking sector and saw the exact same pressure building. He recognized the pattern, trusted his macro read, and deployed capital aggressively. But here's where it gets really interesting, though. Arora operates with zero emotional loyalty.
Not at all.
Like, he will maintain a massive long position on a stock for years, reaping the benefits of that structural shift. And then the moment the data changes, he will instantly flip and short the exact same company.
Yep, he did that with Satyam Computers.
And Idea Cellular, too, right?
Exactly.
But wait, he also explicitly states, quote, "No one knows anything about anything beyond a point."
Right.
So if he truly believes the market is fundamentally unknowable, I have to challenge this idea of intuition. Because when a macro bet pays off 500x, we call it brilliant intuition. But when it implodes, we call it a reckless guess. Is he just playing a high probability guessing game?
Well, that is the essential question of capital allocation. And to unpack it, we really have to look at Sanjoy Bhattacharya, because he would fiercely agree with your skepticism.
Oh, really?
Oh, yeah. Bhattacharya's mental model is the polar opposite of Aurora's macro intuition. He comes from a hardcore statistical background. He literally grew up dissecting business mechanics at the dinner table with his dad, who was an IIM accounting professor.
Wow. Light dinner conversation.
Right. So for Bhattacharya, intuition is just unrecognized bias. He demands rigorous, quantified evidence. He operates on one obsessive mandate, which is what can go seriously wrong.
So he is hunting for the downside risk.
Always.
He actively seeks out companies with a seemingly boring, highly predictable 10 to 15% compounding growth rate, as long as the entry multiple is depressed. And the trade he made on Godfrey Phillips versus a giant like ITC perfectly illustrates this, I think.
It is a brilliant mechanical trade, because if you operate on intuition and narrative, ITC is the obvious play.
Right. They're everywhere.
They have immense entrenched brand power across FMCG. Outside of the Marlboro license, Godfrey Phillips doesn't have anywhere near that level of market ubiquity.
Not even close.
But Bhattacharya doesn't buy narratives. He buys cash flows.
Right. He looked under the hood and saw a massive divergence in capital efficiency.
And exactly how he did it is the real lesson here. Because over a 10 to 15-year horizon, Bhattacharya analyzed the return on invested capital.
Okay.
ITC is this massive conglomerate requiring heavy capital expenditure across diverse sectors, like hotels, agribusiness, and that drags down overall efficiency.
Right. It's too spread out.
But Godfrey Phillips was hyper-focused. Their profits were compounding at a faster rate, their free cash flow yields were vastly superior. And because the broader market was obsessed with the ITC narrative, Godfrey Phillips was trading at a significantly cheaper multiple.
Wow.
So Bhattacharya isolated a mispriced cash flow stream with a massive margin of safety.
Okay, so returning to my challenge then, are they both just guessing in different ways?
Not exactly. They are solving for the exact same equation using entirely different variables.
Okay, how so?
Bhattacharya relies on Rule 3, which is understanding the distinct boundary between uncertainty and risk. Uncertainty is the reality that the future is structurally unknowable. You cannot model a black swan event. It's impossible.
Right, nobody has a crystal ball.
But risk is the measurable damage that uncertainty inflicts on your capital.
Oh, that's a great distinction.
So Bhattacharya mitigates risk through a mathematical margin of safety. He buys at such a sensible entry point that even if growth stagnates, his downside is floored.
He's protected.
Exactly. Whereas Arora mitigates risk through agility and unattached diversification. One uses the shield of valuation, the other uses the shield of velocity. But neither is just guessing. They are both engineering systems to survive the unknown.
Which brings us directly back to that terrifying opening story about the bicycles in the tech company.
Yes, the SSI trade.
Because if you are Sanjoy Bhattacharya and your entire philosophy is built on stripping away narrative to find the mathematical margin of safety, how do you reconcile buying a stock based on a rumor about bicycle parking?
Well, you reconcile it by classifying it as a systemic failure, regardless of the payout.
Even though he made a fortune.
Especially because he made a fortune. That SSI trade violated every single metric of his evidence-based framework. The fact that the stock went vertical and he captured a 500x return, that doesn't validate the process.
Right.
It merely exposes the terrifying reality of dumb luck in chaotic systems. I mean, he eventually sold the position because the velocity of the price ascent genuinely frightened him. The math no longer made sense.
He realized the market was completely detached from fundamentals at that point.
Completely.
And this establishes his vital taxonomy of failure, right?
Yep.
Separating errors of omission from errors of commission.
And this distinction is everything in risk management. Everything. An error of omission is a failure to act.
Okay.
Say you model a great company, you demand a slightly cheaper entry point, it never hits your target, and the stock rallies 200% without you.
That hurts.
You miss the alpha. It damages your ego, and you suffer an opportunity cost, sure. But your actual capital remains completely intact.
So it's like a commercial pilot deciding to delay a flight because the weather radar looks slightly ambiguous, right?
That's a great way to look at it.
Like, it costs the airline money, the passengers are furious, and it turns out the storm dissipates anyway. It's an error of omission, but nobody dies.
Right.
But an error of commission is ignoring the radar, flying a 737 directly into a supercell to stay on schedule, and ripping the wings off the aircraft.
Exactly.
You are actively taking a definitive action that results in catastrophic, unrecoverable damage.
What's fascinating here is that is precisely the mechanism. You can survive an infinite number of flight delays.
Yeah.
You only have to fly into a supercell once to end the game.
Yeah. Game over.
Bhattacharya argues that avoiding errors of commission is the sole prerequisite for long-term survival. And the primary catalyst for those fatal errors of commission, it's market exuberance. It's the hubris of the crowd.
Because exuberance fundamentally alters how you perceive risk in the first place.
It completely anesthetizes your risk receptors. Look at the macro level. Bhattacharya points to Ben Bernanke during the lead-up to the 2008 financial crisis. As the Fed chairman, Bernanke possessed the most sophisticated economic data on the planet. He actively noted the signs of market exuberance and over-leverage in the housing sector.
He saw it coming.
But the euphoria of the broader market created this false sense of systemic resilience. He failed to take the aggressive, unpopular actions required to drain the excess liquidity. Exuberance creates consensus of safety, which is exactly when the fatal error of commission occurs.
And no one is immune to that consensus, right? Not even the wizards, because the ultimate trap for any high performer is the creeping assumption that a prolonged period of outperformance means you have somehow permanently solved the market.
Yes.
Let's look at Arora during that exact same 2008 crisis.
That's a perfect example.
Right.
Arora suffered a massive drawdown because he fell victim to his own overconfidence and a deeply flawed macro narrative.
Right.
Leading into 2008, he had been phenomenally successful. But as the U.S. subprime market began to fracture, he stayed fully invested. Why? Because he bought into the decoupling theory.
The idea that emerging markets had built enough internal momentum to completely ignore a Western economic collapse.
Exactly. The narrative was that India's domestic consumption and growth metrics were basically a fortress.
Right.
Aurora allowed that narrative to override the actual liquidity mechanics of global markets. When the U.S. credit markets froze, institutional capital indiscriminately liquidated emerging market assets to cover margin calls back home.
Just a massive sell-off.
The decoupling theory imploded instantly.
It was a brutal lesson in the inescapable interconnectedness of global liquidity. And it forced a permanent change in his environment, didn't it? Like, to this day, Arora keeps physical statues of both a bull and a bear directly on his desk.
He does.
It's this constant, visceral reminder that no matter how bulletproof a thesis feels, you must maintain the cognitive flexibility to abandon it the second the underlying facts shift.
And Bhattacharya applies a similar psychological guardrail, but he focuses on the institutional mechanics of failure. When an error of commission occurs inside a large organization, the immediate corporate reflex is a witch hunt.
Oh, always.
The system demands a scapegoat. Who modeled this? Who signed off?
It's the instinct to personalize the systemic failure.
Which is incredibly corrosive to long-term performance. Bhattacharya mandates that you cannot personalize a miscalculation, either against yourself or a team member.
Because it just breeds fear.
Exactly. The moment you introduce the threat of personal destruction into a post-mortem, you destroy self-belief and incentivize cowardice.
Wow.
Analysts will start hiding data. They will retreat into consensus trades because it's safer to fail with the crowd than to take a calculated, idiosyncratic risk. The purpose of analyzing a failure isn't to extract a pound of flesh. It's to objectively identify the flaw in the analytical engine and recalibrate it.
Okay, I have to push back on this entire premise, though, on behalf of the listener.
All right, go for it.
Because both of these investors firmly believe in what Arora calls the great study buddy fallacy. They argue that you cannot simply read a book like the one we are analyzing today and absorb the lessons of their failures. Mm-hmm. They insist you must have your own capital exposed. You have to endure the psychological trauma of a drawdown.
Yes, they do.
And we know that even the best institutional funds operate with a 30 to 40% loss rate on individual positions. That's just the mathematical reality of the business.
It is.
So if failure is a statistical certainty, and they insist we have to pay our own tuition fee to the market to truly learn, what is the actual utility of analyzing their confessions? Why are we doing this deep dive?
Okay, if we connect this to the broader architecture of risk, the utility becomes obvious. The fallacy isn't in studying their mistakes. The fallacy is believing that studying them will grant you immunity from making your own.
Oh, I see.
You're going to pay the tuition fee. The market guarantees it.
So we are just learning how to fail cheaper.
We're learning how to prevent failure from becoming an absorbing barrier.
An absorbing barrier.
Yeah, in probability, an absorbing barrier is a state from which you cannot recover. Bankruptcy, a blown-up fund, a destroyed career. The utility of this deep dive is understanding how to construct an ergodic system.
Well, okay.
An ergodic system ensures that no single loss or series of typical losses can remove you from the game entirely. Aurora's elimination investing and Bhattacharya's margin of safety aren't designed to achieve a 100% win rate.
Because that's impossible.
Right. They're designed to ensure that when you land in that inevitable 30% failure bracket, the damage is contained. You suffer an error of omission, not a fatal error of commission. You pay the tuition fee, analyze the data objectively, and you survive to deploy capital the next day.
So what does this all mean for you listening right now? How do you map the architecture of these financial wizards onto your own decisions?
Well, there are a few ways.
Right. First, I'd say audit your current trajectory through the lens of elimination investing. Stop agonizing over finding the perfect optimal choice and ruthlessly eliminate the obvious structural flaws. What toxic processes, over-leveraged projects, or misaligned partnerships can you reject right now to protect your baseline? And second, brutally evaluate your actions for errors of commission. Are you flying into the supercell just to prove a point?
Are you letting exuberance override your risk models?
Yeah. And finally, when the data inevitably turns against you, step away from the ego of the sunk cost. Accept the new reality, recalculate the odds without attachment, and pivot, just like the GPS.
And as you move forward, I want to leave you with a deeply uncomfortable diagnostic question.
Okay.
Examine the absolute biggest success in your portfolio or your career right now. The win that defines your current status. Strip away the narrative and look at the raw mechanics of how you achieved it. Was that success genuinely the result of a rigorous, repeatable, structurally sound process? Or was it just your version of too many bicycles outside a building?
Wow.
And more importantly, if the macro environment shifted tomorrow and the dumb luck evaporated, would that shining success immediately reveal itself to be a catastrophic error of commission just waiting to happen?
That is the exact kind of diagnostic clarity we usually avoid, because it forces us to admit that we aren't operating on a flawless blueprint. We are navigating the muddy waters, constantly trying to separate genuine insight from unrecognized bias, and hoping our systems are robust enough to survive our own blind spots. Thank you for joining us on this deep dive. Keep aggressively questioning those assumptions, and we will see you next time.